Yes, good afternoon, traders. I hope we are all doing well. Welcome to Traders Hub YouTube channel, where we post trading educational content and weekly analysis. Today, we are starting a new series of introduction to financial markets and how to start trading. For the ones who are new in this channel, my name is Maalim Athman, a trader from Lamu with over 8 years trading in the financial markets. Yes, this series is for beginners who want to venture into financial markets and make a career out of it. And so we are going to start with the basics from the introduction, Forex terminology, dissecting the players of financial markets and how we can capitalize on the opportunities presented by these financial markets. Introduction to financial markets. Financial markets, in simple words, these are places where people buy and sell financial instruments such as currencies, stocks, cryptocurrencies, commodities, and other investment products. These markets connect buyers and sellers from all over the world and create opportunities for investment, business growth, and wealth creation. The financial markets plays an important role in the global economy because it allows money to move between investors, banks, companies, and governments. Every day, trillions of dollars are exchanged across different markets. Yes, there are different types of financial markets, but we focus mainly on Forex market. And yes, other than that, there is a stock market, cryptocurrency, and and cryptocurrencies. Yes, what is the Forex market? The Forex market is the largest financial market in the world where currencies are exchanged against each other. In Forex market, these are two words. Forex, these are two words, being foreign currency exchange markets. In a day, over 3 trillion worth of currencies are traded. And that's why there are lots of opportunities to capitalize from. For example, Euro USD, Euro against US dollar. GBP USD, this is British Pound against US dollar. And normally the Forex market operates 24 hours from Monday to Friday because banks, institutions, and traders worldwide are constantly exchanging currencies. Yes, history of the Forex market. The Forex market began as a system for exchanging currencies between countries to support international trade and global businesses. For many years, Forex trading was mainly controlled by central banks, commercial banks, governments, large financial large financial institutions. Before the internet era, only institutional traders and big banks had access to the Forex market because trading required huge capital, expensive systems, and direct connections. It is due to the 1990s and early 2000 technological advancement and online trading platforms opened the Forex market to retail traders around the world. And retail traders could now trade from home using computers and smartphones, access global currency markets with smaller capital, use online brokers, prop firms, and trading platforms like MetaTrader and City Traders. And thus today the Forex market operates 24 hours a day and is the largest financial market in the world with trillions of dollars traded daily. Yes, moving forward, how do the Forex market work? Normally, currencies are traded in pairs because when you buy one currency, you are simultaneously selling another. And for example, if you believe the euro will become stronger than the US dollar, you buy Euro USD. And if the price rises, you make profit. And if the price falls, you make the losses. And the same way, if a tourist let's say visits let's say Kenya, and they want to buy a service or buy even a product, and that normally most of these goods or products in Kenya are sold in their local currencies, and that they have to sell their currency and buy the currency of the local country in order for them to facilitate that trade. And that means they are simultaneously selling their currency or the local currency in order to access their local services and products. I think that is as simple as it can get. Yes, moving forward, who are the participants of the forex market? And yes, major participants in the forex markets are the central bank. These control a country monetary policy and influence currency value through interest rates and money supply. Example of these central banks are Federal Reserve, European Central Bank, and any other local central banks. Yes, other than the central banks, we have the commercial banks. These banks provide financial services and also trade currencies and commodities and other assets. Examples can be the JP Morgan Chase, Goldman Sachs. In Kenya, we have the KCB Investment Bank and others. Yes, other than the commercial banks, on this tier, we also have the hedge funds. These are private investment firms that trade aggressively to generate profits. Yes, and example of these are Bridgewater, funded by the great Ray Dalio. We also have Bridgewater Associate, Two Sigma, and many others. And yes, other than the hedge funds, we also have companies. These are large corporations. Mostly, these corporations participate in trading mainly for international business transactions and hedging currency risk. Examples can be Apple, Tesla. We can also have Safaricom here. As you all know, the internet in Kenya is mostly imported, and for that case, we also have to pay it in the currency that we import it from. Yes, moving forward, how does the forex market facilitate? Yes, I'm very sure many people ask themselves, how do these forex market facilitate businesses? Yes, and this we can give a good example. And for example, a company like Toyota may exchange Japanese yen to US dollar when importing goods. Another example is that a hedge fund like Citadel may speculate on currency price movements, make profits, okay? And the same way, a central bank like Federal Reserve can move the forex market by changing interest rates, okay? Yes, and other than that, we can have investment banks like JP Morgan Chase providing liquidity and execute large trades in the forex market for their clients and etc. Yes, forex terminologies. And for us to properly understand the financial markets and properly to understand trading and forex market trading, we have to familiarize ourselves with this terminology. And the first terminology is PIP. Yes, PIP, or percentage in point. This is the smallest standard price movement in a currency pair. Yes, for example, when you open Euro USD chart and the Euro USD chart moves from 1.1000 to 1.10, and that you will take the second number, which is 1.100, and subtract it to the first the initial price, which is 1.100, and you'll get that Euro USD has moved 1 pip, or 1 percentage in point. Second example is that Euro USD moves from 1.100 to 1.1010, and that will equate to 10 percentage in point movement. Yes. Moving forward, we have the lot size. What is the lot size? Lot size, in simple words, this is the volume of a trade. Yes, the volume of a trade, or the power of the trade. Yes, or the buying volume, buying power of the trade. We have several lot sizes. The first lot size we can have is the standard lot size, which equates to 100,000 of units. And normally, the lot size is normally one lot size is equal to 1.0. Forgot to indicate here, but yes, one lot size is equals to 100,000 units of the currency that you bought. And normally any pip movement by the standard lot size equates to around $10. Yes, mini lot. This is 10,000 units of currency that you've bought or sold in the market, and this equals to 0.10. And I think I'll have to show you exactly what I mean with this. Yes, and the smallest lot. Yes, the smallest lot size is 0.01, which equates to 1,000 units of currency bought or sold. Yes, moving forward, leverage. What is leverage? Leverage, this in simple words, this is a facility that allows a trader to control a larger position with a smaller amount of. For example, you can have leverage from 1:10, 1:100 to even 1:1000, but preferably with between 1:30 to 1:100 is modest type of leverage. Yes, and in this case, when you have 1:100 leverage, this means that any $100 that you deposit in that account can position worth of $10,000. Yes, and that's what leverage. And margin is the amount of money required to open and maintain a leveraged trade. Yes, yes, again, you can ask yourself, what is this amount of money required to open and maintain a leveraged trade? Yes, for you to be able to participate in this financial market or in the forex market, you have to have at least some amount of money in your account for you to open any position, and that is the margin that we are talking about, the money that you deposit in your account for you to trade with. Okay, yes. And again, the spread is the difference between the bid and asking price, or this is the difference between the buying price and selling price. Okay, and this, in simple words, I can say this is the difference of price that normally the brokers or banks put in place for them to make a profit and to be able to facilitate this trades or the market. And for example, always you will see that between the bidding and asking price, or the buying price and selling price, there is always a difference of between 1 2 to a maximum, depending with the broker. Okay, you can have between 1 to 2, that is the lowest spreads that you can get. Some brokers also still offer raw spreads, which are zero spreads, but between 1 to 2 spreads, yes, you will always find spreads between 1 and 2. Yes, moving forward, buying or longing. Whenever someone says I'm buying or I'm longing, for example, euro, this means that I'm opening a trade expecting the market to rise, or yes, I'm opening a trade and expecting the market to rise, okay, in price. And selling or shorting, this means opening a trade and expecting the markets to fall, or yes, to fall in price. Again, stop loss, this is an order that automatically closes a trade at a specific loss level. And I think this we will understand when we are moving forward. And take profit, and again, this is an order that automatically closes a trade at a specified profit level or profit target. And risk to reward ratio, this compares the amount risk to the potential profit. Okay, yes, I think that is self-explanatory. An example is whenever one is risking, let's say, 20 pips and looking for reward of around 60 pips, that means his risk to reward ratio is 1:3. And last but not least, the trend. The trend, this is the general direction of the market. And the trend can be the trend can be bullish trend or bearish trend. It can be a rising trend or a falling trend. Okay. Yes. Moving forward, we have the Forex trading sessions. Yes, as we all know, the Forex market operates 24 hours a day through 4 major sessions. And these sessions are the Sydney session, which opens around 10 p.m. GMT and closes around 7 a.m. GMT. The second session is the Tokyo session, or we call it a Asian session, and this usually opens around 12 a.m. GMT and closes around 9 a.m. The third session is the London session, and normally this opens around 8 a.m. GMT and closes around 5 p.m. GMT. Yes, the London session has the highest trading volume, and mostly major moves occur during this session. And again, last but not least, we have the New York session, which is the United States of America session, and usually it opens around 1 p.m. GMT and closes around 10 p.m. GMT. The New York session is characterized by the high volatility, especially during major US news. Okay. And moving forward, yes, we have the Forex trading elements, and these are the most important Forex trading elements. The first trading element is the technical analysis, and this is using charts and indicators to predict market analysis, market direction and movement. Okay, and the second element is the fundamental analysis, and this is studying economic news. Economic news such as the interest rates, inflation, employment reports, and gross domestic product. as they usually influence the movement of their local currency whenever they come negatively or positively. Yes. And the third forex trading element, we have the psychology. Psychology, this is understanding, first it's understanding the overall market psychology, and again mastering your personal psychology, because as we all know, in forex trading, money is involved, and normally there is either winning or losing in these markets. And because money plays an important part in our life, losing here and there can take a toll in our brain, and that is very important for us to keep our psychology in check during our winning streaks and losing streaks. And last but not least, this should be the first element, but nevertheless, risk management. And risk management, this is the overall trades and risk management. And usually it entails a trade risk portfolio, allocation, and management. Yes, I normally say that us as traders, we are first risk managers before being traders, because with the wrong risk here, with the wrong risk allocation, you can get it wrong from the first step. And that's why we are first risk managers and secondly traders. And I hope we have understood the introduction to the financial markets, and specifically this introduction episode where we have dissected the introduction to the financial markets, what is the financial markets, trading in the financial markets, major players, pairs and sessions, and most important terminologies of the forex markets. And for that, I think we've reached the end of this episode. And for the ones who have just joined this channel, this is Traders Hub YouTube channel, where we post trading educational content and weekly market analysis. And this is our series of introduction to forex market and a beginner course for the ones who want to venture into forex trading. And so I'm looking forward to catch you in the next episode, as this is our first episode. Please don't forget to subscribe to our channel, hit the notification bell, hit the notification button, and find our links on the description below, and join our platforms. Ciao.